and I now invite Governor Scicluna to deliver his opening remarks.
Very good. Right. Distinguished guests, ladies and gentlemen, it gives me great pleasure to welcome you to this second seminar on the 15th edition of our Financial Stability Report. As you know, this is our flagship report by which we reflect the bank's remit on macroprudential as the macroprudential authority on the island, and documents the analysis and work schedule we undertake to fulfill this mandate. I can state with confidence, let's start, which is quite important, and also stated in this edition, that the Maltese financial system has shown considerable resilience to shocks that occurred in the recent past. Just as economies were recovering from the pandemic, which induced a slump, the war in Ukraine broke out, by which it's exacerbated the supply bottlenecks we've had, raising inflationary pressures. This has brought an end to the decade-long era of cheap funding by central banks, with interest rates rising to the highest level seen in the great financial crisis, with the last raise made last Thursday. This unprecedented rapid monetary tightening heightened volatility in financial markets and affected the investment portfolios of the banking sector. Similarly, domestic relevant non-bank institutions were also affected. Yet, we can say that all these entities still continue to operate with sufficient capital and liquidity buffers. More details on the strengths and weaknesses of our financial system will be given in the first presentation of the seminar. The second presentation discusses an innovative cyclical systemic risk indicator for Malta. This composite indicator, and here I thank the department and the unit which have worked hard and try to improve on other countries, because each country has its own set of quirks in the data and so on, so it had to be tailor-made and in a very innovative way for us. And it's based on a subset of variables that are judged to have suitable early warning properties, like shocks and Maltese disease. Ideally you need some warning, and this will come from inside. And this will also serve as an additional tool that the bank will use to extract further information about our accumulation of cyclical systemic risk over time, and also serves as a useful input in our policy-making process. This year we have also invited over a panel of distinguished speakers to discuss the role of macroprudential policy in a tighter monetary policy environment. It is well documented in academic literature that there cannot be price stability without financial stability, and vice versa. At the same time, the interaction of these two policies can create unintended consequences, and authorities need to weigh possible trade-offs. It is indeed a balancing act. It is for this reason that we at the Governing Council are presented with an in-depth technical analysis on the interactions of monetary policy and financial stability ahead of each of our monetary policy decisions. The banking turmoil we have seen last March, both in the US and also in Europe, not in the EU, but luckily not in the EU, but has definitely is a powerful reminder of the challenges posed to authorities when focusing on price stability and financial conditions. A stable and resilient financial system is an essential prerequisite for price stability, and in times of stress, central banks must act swiftly to restore orderly market conditions and ensure financial stability. We lived through this March crisis when we were in the Governing Council, and you could witness at first hand how, trying to avoid a panic, really, and to keep level-headed. And whatever you have to do it very fast before markets open on the following Monday. As a central bank, we are committed to continue working with industry and its stakeholders and other authorities as well to keep delivering on our financial stability mandate, while at the same time continue to develop our assessments and research capabilities to provide risk-based, evidence-led policy solutions. All these issues will be the subject of the upcoming presentations and the panel discussion later on in the program. So, once again, thank you for all for joining us this morning.
Thank you, Professor Scicluna. At this point, we would like to inform you of a slight change in the program, and so I would like to invite now the next speaker, who would be Mr. Alan Kassar, the bank's Chief Officer responsible for financial stability and statistics, who will focus on the key highlights from the Financial Stability Report 2022. Mr. Kassar.
Good morning all, and welcome to this seminar from my end as well. So, in financial stability, we are constantly concerned with uncertainty and the risks that these propagate on financial systems. And no matter the sources of these risks, financial systems, resilient financial systems, must be able to absorb shocks and keep on functioning. And with respect to risks and uncertainty, as the Governor mentioned already, 2022 kept us very busy indeed. Last year we have seen quite a confluence of shocks, with a brutal war in Ukraine raging on. Supply chains were still recovering from an unprecedented pandemic, whilst inflation soared. This caused monetary authorities to respond by tightening their policies. At the same time, volatility returned to the financial markets. So in a nutshell, this was the macro environment faced by the financial sector in 2022, an environment which challenged policymakers and institutions alike to take note and adapt to these changing conditions. Hence the choice of the title of this seminar, Stability in a Changing Landscape. So how did the Maltese financial sector and the banks in particular fare in such changing environment? To answer this question, we'll be using the analysis of the FSR, but we'll put it in a sort of a SWOT framework to give it more context. So we'll start from the strengths, moving on to the weaknesses, all vulnerabilities. I'll be using these terms interchangeably. I will be taking the liberty as well to change the direction, the order of threats and opportunities, because as I will be arguing, some of the threats that we'll be mentioning present also opportunities. We'll also update the trends and latest data wherever possible, since we're already in September now. So moving on to starting from the strengths, the FSR highlights a number of strong points, and really a staple of the Maltese banking sector now. Capital levels continue to surpass the EU average and also the pre-pandemic levels. As you can see in the update for the first half of 2023, we see the same sort of strong numbers. With respect to profitability, the recovery kept very well underway, aided also by the monetary tightening and higher interest rates. The rate of return of the sector, as you can see as a whole, continued to surpass the EU average and the domestic pre-pandemic levels. For the core banks as well, here we see also a remarkable recovery, particularly if we consider the prudent stance that banks, this category of banks took in 2020 in response to the pandemic by taking conservative provisions, which were then subsequently released as the pandemic abated, progressed. And the risk assessments of these clients improved. In fact, the rebound from 2020 to 2021 for the core banks was even bigger if you had to calculate the change than the EU average. For 2022, one also has to consider one-off increase in operational costs experienced by one of the core banks, which dragged a bit the numbers down. However, when you look now at the second half of 2023, you see that profitability is back, surpassing EU average. Another strong point that defines the Maltese banking sector, and this is documented in our FSR, is the strong liquidity levels. The LCR and the NSFR, you can see, are very, very strong. At the same time, deposits continue to flow in the system in 2022, however, at a slower pace. Obviously, when you compare to the pandemic years, which were in turn influenced by higher savings in view of the social restrictions that brought this along. Indeed, we have been seeing this consolidation in the deposit growth for quite some time now, and this is not just for household, but also for the non-financial sector as well, both the financial and the non-financial corporates. More recent data shows an even slower growth, apart from this base effect of higher past numbers in terms of growth. There is also dynamics that suggest a search for yield from depositors. For example, we have seen deposits flowing more towards the banks that have offered higher rates. So there is also an element of rebalancing there. And at the same time, we have to keep in mind as well that higher yields in low-risk liquid assets are acting as substitutes to deposits. And even the second half of June, also the second half of 2023, has coincided also with government stocks issues as well. Asset quality continued to improve. You can see as well very encouraging numbers in terms of the NPL ratios, standing now at 2.6%. So they're very encouraging numbers as well. And last but not least, on this slide, another characteristic that we have highlighted in our FSR this time round is the predominance of securities held to maturity on the bank's investment portfolio. This has shielded the banks from an adverse impact on their investment books. In fact, we try to explain the different accounting treatments as well of different investment strategies in the banking book, so as to distinguish us also from what we have observed in the US banking turmoil as well. Sorry. Okay, just to continue a bit on the stress test results, because these also hint to a number of strong points. The FSR will document positive outcomes in very adverse scenario assumptions, including bank run types. In fact, we have also modified our scenarios here to mimic what we have seen in the SVB case in terms of more intense deposit outflows, and we have seen also their encouraging numbers. At the same time, the overall banks were found to be able to absorb adverse impacts from sustained losses over the 3-year horizon. Furthermore, our stress test confirmed that higher interest rates have a net positive effect on bank profitability, and this is attributable to the bank's ability to keep higher margins, but also, as I mentioned before, the predominance of AMC portfolio shields banks from the negative effects of rising interest rate. So here, very encouraging numbers as well on the stress test side. Turning to the non-bank sector, which is also covered extensively in our report. In fact, the FSR has a dedicated chapter, as you know. The domestic insurance sector and the investment funds weathered the turbulence of 2022 very well, with both strong solvency and liquidity ratios. And this does not mean that they didn't experience turbulence or any adverse effects from economic and market developments throughout the year. This is something that the FSR documents as well there, but notwithstanding this, the overall message is that these entities remained quite resilient, and it's a reflection also of their prudent models. Moving now to some weaknesses or vulnerabilities that the FSR talks about. So one of the main issues that we discuss is the sustained growth in mortgages, which is in turn resulting in a more concentrated loan book. Indeed, despite the slowing down in terms of mortgage growth rates, it is still quite a considerable growth rate. It's 7.8 till June 23. These sustained high growth rates are in turn resulting in higher concentration. As you can see from the right-hand side of the panel, total loans increased, the share of total loans increased, has been creeping up from 26 in 2004 to 55 up to June. And this is mainly what drove us as well to introduce the sector systemic risk buffer to target this component of credit. Furthermore, if you had to add construction and real estate here as well to the share, it goes up to 67% up to June 23. So from even here, another interesting highlight here is that from a cyclical perspective, this credit component, construction and real estate, has also been the main driving force behind the recovery that you see from 2022 onwards in the NFC. So the NFC recovery that you see there is predominantly coming from the construction and real estate sector. This can be seen more clearly here in this next slide. You see on the left-hand side the growth in NFC lending predominantly stemming from real estate activities in 2022. This is also attributable to the fact that there were, this is from the discussions we have with banks, some pent-up demand from projects, mainly within the accommodation and tourism sector, that were slowed down during the pandemic, and then they came on stream. And this, you can see as well, there are a number of other sectors, the blue bars there, that lately have shown increases, like the energy, public administration, wholesale, health and the art sectors, but their growth remains quite volatile. So we have already seen some slowdown there as well. And then there are also other sectors that keep registering low or negative growth. So in a nutshell, the NFC credit growth is still not homogeneous, and its recovery remains quite uncertain. And obviously, the current environment that conducive of higher interest rates might drag also the credit demand even lower here. It is also worth noting that the construction and real estate sectors have a history of high NPLs, and they tend to be very sensitive to market corrections in real estate markets. This is what we've learned also from the aftermath of the great financial crisis, when the Maltese real estate market corrected. NPLs in these sectors had increased, and it took quite a long time for banks to resolve them. So this is something that we need to keep in mind going forward. Turning to the household sector, the right side of the panel, one can see rising vulnerabilities there also, which in a way are also closely related to exposures to real estate, given that the lion's share of the household's liabilities are in the form of mortgages. As you can see, both the debt to financial assets, the blue line, and the loans to disposable income, and the red line, have reversed trends from 2017, 2018, and keep creeping up. So this is something that we are keeping tabs on. Obviously, granted, I mean, the household balance sheets on average on aggregate remain very strong, so we are starting from a very strong position. This is something that the FSR also mentions, but obviously our job is to keep tabs and looking under the hood what's going on, and this is something that something to watch. So we have to keep in mind also two key considerations here. First of all, when we talk of household resilience, we usually talk about households in general, as I said, but this does not mean that there aren't any pockets of vulnerabilities within the distribution. This is something that obviously banks are concerned with, because any point of the distribution is a counterparty for the banks as well. So it's something that more than of a systemic nature, it's also an important point for the banks to take note. Another aspect is the fact that according to our studies, we know that households are more vulnerable to rising interest rates and rising living costs, so higher inflation. Both of these risk triggers are quite plausible in the current scenario that we are living. So this is why we are keeping tabs on these developments. In fact, our stress test, on the one hand, they show the resilience of the household sector on aggregate, but they do confirm pockets of vulnerabilities in the distribution, especially at higher income levels. So, for example, from the exercise that we conducted, we know that according to our studies or our samples, there is around 10% of households who exhibit a negative financial margin. So their outlay is more than their recurrent income. This doesn't mean that these households are bankrupt. It means that they are saving, so they are eating from their own savings. Obviously, it's something that cannot go on indefinitely at some point. Also, with the same token, our stress test from the banking sector, we have a whole chapter, as you know, about this, and we do test a number of scenarios, very strong scenarios there. We are concerned there, the total, the systemic results, which are very good, but obviously we can also look at certain banks, and we know that there are certain banks that are more sensitive than others with respect to their business models and the assumptions that we take. Again, these are not forecasts, these are not projections, but they are stress tests. So there, what we are doing is taking very strong assumptions, adverse scenarios to see, to try to unearth vulnerabilities in the banks that we survey. Moving on to the threats, or more generally, the sources of future risks. The FSR hints that we are not out of the woods yet. Frankly speaking, I mean, in our business we never are, so we're always looking at what could happen. Primarily to these risks are basically the macro environment, which has not changed even from the analysis of the 2022 in terms of outlook, and if anything, I think it has worsened, especially if you look at what's happening in Germany, for example, and China. Obviously, a worsening environment on the macro will impact banks adversely by, for example, lower credit demand, the ability for them to maintain margins and profits by default, and also there might be also issues of asset quality if the macro continues to deteriorate. Moving on to technology, first of all, the risks in terms of cyber attacks are on the rise. This is something not new, and it's more so in the troubled times that we are living at the moment. At the same time as well, I don't think that banks need any lectures from myself about the importance to keep at pace with disruptive technology in the industry, so for them to keep, to keep their market share. The last point here is about climate change. Obviously, this is an overarching threat. At some point, the banks will see themselves facing rapid changes in both the transition to the sustainable economies, as well as the physical risks that these might threaten their counterparties and by inference also their asset portfolios. Lastly, in terms of opportunities, obviously, as I said, some of the threats can also represent opportunities for the banks. On this point, the FSR mentions, for example, the opportunities for banks to address the need to reduce their dependence on real estate activities by focusing more on financing the transition to the green economy. I mentioned as well a number of sectors that are subdued in terms of their credit demand, and perhaps these could be seen as opportunities for banks to find new niches there and unearth some latent demand in terms of different business opportunities. Also, recent history has shown that being prudent pays, as we have also mentioned to this. So when facing uncertainty, being prudent is important. So it's important I think that even the strong fundamentals, the strong financial fundamentals that I made reference to earlier, it incentivizes banks to remain prudent and keep adequate provisioning policies. The same goes for their dividend policies. I think they are in a position to adopt sensible policies in terms of dividend distributions without jeopardizing the ability for them to meet upcoming regulatory requirements like MREL, for example. A message that we always put in our FSR, and also when we discuss this, is it's always important, it's always better to keep capital and maintain it organically rather than they have to scramble then to meet the requirements on an ad hoc basis, because the cost of funding could be quite high then. Last point, despite the threats posed by technology that I mentioned, it also presents the banks with various opportunities, particularly with the higher capacity offered for these institutions to digitize more effectively their operations. Also, the last point that I wanted to share with you is basically that technology offers also various opportunities for banks to be more effective in addressing their AML CFT threats, but at the same time minimizing the risks for genuine prospective clients being denied the required banking services. So it is an opportunity there. So in other words, technology could present banks with the capacity to be less risk averse ex ante when they are onboarding clients, and more risk sensitive and more nimble ex post. I think technology is really key here, and we have already seen investments going this way, and I'm confident that we'll be seeing more investment in the coming future in investments in technology by the banks. So I think I can stop here now, and I'll be happy to answer any questions after the panel discussions. Thank you.
Thank you, Mr. Kassar, for your SWOT analysis on the Maltese financial sector. We'll now move on to the keynote speech of the seminar. And we are honored today to have with us Honorable Minister Clyde Caruana. Honorable Minister Caruana, the floor is yours. Thank you.
Good morning. It's a pleasure to be here for this annual event to share some thoughts with you about the local economy, what's happening around us. And first, I would like to start by referring to what's happening first at European level, because of course we're part of the bloc, and needless to say, what happens across the Union at the end of the day will have significant effects on us as well. I have to start by saying that perhaps the way how things were moving 2-3 years ago, the priorities that the Commission had way back then are not the same priorities that we have ahead of us today. Why? The Ukrainian-Russian conflict has changed in a very significant way the frame of mind across all EU member states. And the way the frame of minds have changed, I would have to say it is very significant. I've been participating even in my previous life, in various fora related to employment, related to finance. And the way we used to discuss things used to take ages in order to find some kind of compromise. The way how things are moving now, it is a complete different ballgame. Things are moving in a very fast way, such that whereas before those years, like the one that we have ahead of now, as ministers of finance, the economic governance framework, the one that's going to amend the Maastricht criteria with respect to the excessive deficit procedure. Whereas before something like that would have taken at least 3-4 years, if not more. Now, in a couple of months, perhaps a year, because there has been a communication throughout the weekend that there is the intention to try to come at an agreement this year, that shows that the EU leaders are becoming more decisive, and the actions that they need to take are becoming bolder by the month. Of course, this is taking place within a framework where, even as the EU President has announced, where the EU is likely to welcome other states as part of the bloc in the foreseeable future, perhaps by the end of the decade. It would be a tall order for such countries to join, given all the reforms that they have to do, but there is this conviction that these countries would be welcomed within the EU. And why I'm saying this? I'm saying this because in an enlarged Europe, this will bring about significant changes to the way how the European Union works and governs itself. how all this is related to the economy. Well, for such block to continue to move on, the amount of resources that will be required is significant. And therefore, the need to keep on reforming will be as important as ever. We just have to look at what is happening, for example, with respect to Pillar 2, the minimum level of taxation. As you are aware, the United States has not yet ratified the OECD agreement. I mean, they were amongst the cheerleaders, but they still haven't ratified it. Yet, Europe is still moving ahead, and many member states will be implementing such decision as of coming 1st January. So that gives us an idea that irrespective of what others will be doing across the globe, Europe is still adamant to move ahead, to make sure that the necessary resources will be there in order to undertake the necessary reforms across the board. One of the reforms that I've already mentioned is the changes that have to take place with respect to the economic governance framework, whereby, as you are aware, the excessive deficit procedure is going to be lifted, meaning that we go back to the previous rules, but perhaps rules which will be amended, and there is, as I said, the resolution to amend them by the end of this year. That means that the Commission, together with the Member States, will once again focus on good governance with respect to the fiscal balance of each and every Member State. And that is, of course, something that everyone welcomes, because at the end of the day, we have to make sure that the continent and all Member States would be on a good financial basis if we had to face another exogenous shock as the two that we have faced over the past years. I'm referring to COVID, followed by the Ukrainian conflict. So what Europe is doing, of course, is that it's preparing itself, it's preparing its member states to face the upcoming challenges. And the upcoming challenges do not only relate to the usual issues, competitiveness vis-à-vis other jurisdictions, but now we're moving one step forward, and as all of you can read on a daily basis about, Europe is embracing wholeheartedly the green move. The resolve that exists across the room when we meet at ECOFIN level, the pressure, I thought that most of the ministers of finance perhaps would call for caution or for some pause, given the extraordinary shocks that we're still being faced. Yesterday I was looking at the price of oil, and it seems that it's heading at $95 per barrel. So the upward pressure on the price of oil is still there, and it's highly likely to continue to surge in the coming days. But notwithstanding all this and all the pressures that the supply side of the economy may face in the coming weeks and months, the ministers of finance are adamant more than ever that Europe has to double, if not treble down, on its efforts in making possible this green revolution that is taking place. And I'm saying all this because whereas perhaps in the past years, decades, we were accustomed to a union that is very much slow-moving, decisions take years to be agreed upon and to be implemented, all that is now changing. And it is changing as a result of an environment that is changing at a very fast pace. So, of course, the rationale is that all this change that is taking place has to be counteracted by faster change. how does this translate within our shores? We have to take note of what is happening for the simple reason that we cannot just take it for granted, the fact that we have done well after COVID. We're still weathering the challenges that we have with respect to energy, I would say, in a good way as well. But this does not mean that we should rest on our achievements and take it for granted that everything will be okay just because everything was okay in the past. Member states are embracing significant reforms. I mean, you just have to look at what, for example, the Germans were doing recently. And I think that even ourselves, we should look at the future on a very positive note, but at the same time, we have to take note what others are doing. We have to make sure that the supply side of our economy, I mean, in times where inflation is what it is, the governors, I'm quite sure that they are, or they've been, quite busy throughout the past months looking at the numbers and see what's going to happen with respect to inflation. At least what the numbers and the general consensus seems to be is that the inflation rate, although it's coming down in general, but it's still a long way from reaching the desired 2%, and that is likely to take much longer than expected. So, of course, in this environment, while the central banks are doing their utmost in order to control money supply, make the necessary leverage with interest rates, fiscal policy is what it is, and of course it has its limitations because overdoing it with fiscal policy can have its repercussions on the economy. So all in all, I would say that most of the solutions at the end of the day would revolve around taking care of the supply side of the economy. The demand side is what it is. There's no need to stimulate it. It's taking care of itself. It has been going quite well and robust. So when we look at the tools that we have at hand in order to address the challenges that we have ahead of us, the more one thinks and the more one looks at the prescription that is available, the more narrow it becomes, and the more obvious the choices that we have ahead of us become obvious. And why is it that I'm referring to the supply side of the economy? I'm referring to the supply side of the economy because if we look at the recent past, our economy did well when we induced the necessary supply side measures in order to unlock any untapped resources such as people who are still inactive, energy prices that were a bit on the high side, and addressing other bottlenecks that made it possible for our economy to produce more. For the years to come, in my opinion at least, I would say that the name of the game is still the same, but perhaps in different ways and means. Our islands are what they are in terms of size. So whereas we have to continue our pursuit to enhance economic growth, it doesn't mean that the path has to be the same as it was over the past years. The end result has to be the same, but it doesn't mean that the way how we achieve that is the same. It's easier said than done, but of course we have to do our utmost in order to make sure that we change, because the circumstances around us are changing, and I would say at a very fast pace. Now, if there's one advantage that we have as an island is that we're small, and at times we can embrace change and do the necessary things that ought to be done in a swift manner. Perhaps this is a luxury that other big countries don't have, for the simple reason that when you're big, of course, it takes much more effort to make sure that everyone follows in the same direction. Now, this is something that we have to embrace more because, of course, the changes that the Commission, the things that the times we're living in will demand from us will remain there. So how we have to do this? We have to do this, of course, by thinking a bit outside the box. We have to look at the things that we're doing and make sure that if there are things that are inefficient, and we do have inefficiency. I mean, one of the biggest, perhaps, disadvantages when an economy is doing well, and it keeps doing well for a long time, is that certain inherent inefficiencies take place, and those inefficiencies remain there forever. Again, it's easier said than done to trim such inefficiencies, but we have the courage to look at such things because, as we all know, as economists know, when we free resources that are being inefficiently used, those resources can be put at better use somewhere else and can perhaps be more productive. I continue to believe that in terms of taxation, perhaps I'm a bit of more, I tend to lean a bit more on the right wing of the political spectrum here. I tend to believe that the state should always remain as lean as possible, because at the end of the day, the more government taxes, the more those resources can be spent in an inefficient way. So, of course, I do remain convinced that the tax burden that we have is enough. There's no need to introduce or increase any taxes. What we have to do is that make sure that the way those resources are spent in a more efficient manner. At the same time, I think that the private sector should also raise up to the occasion. Unfortunately, at times we tend to expect that most of the change is brought about by government. I subscribe to the notion that it should be the other way around. Government is not there to bring about change. Government is there to support change, which is an entirely different thing. So I think that our business leaders, our entrepreneurs, should put forward their ideas, the way how our economy should, and I'm going to be very careful the way I use this word, not grow, develop, because there's a big difference between growth and development. The way how our economy should develop in the foreseeable years, for the simple reason that people at large nowadays, they are not just after income, but they are after the improvement of their general well-being, which of course is more widespread than just looking and being myopic and looking at just income. So I think that what we have ahead of us are interesting times which, as I said, will bring about challenges that I think we're weathering quite well. Our financial system, as recently pointed out also by Fitch, is quite sound. We do not have certain issues that other countries are facing within their banking systems. But nevertheless, we do still have other issues that we need to look into in order to make sure that government works as efficiently as possible, because ultimately at the end of the day, this should help our economy to keep on growing in the coming months and years. I think that by and large, I've touched upon most of the points that I had today. Once again, I thank you for your attention, and also I would like to thank the Governor for this invitation this morning. Thank you.
Thank you very much, Honorable Minister Caruana. Our next presentation discusses the construction of a domestic cyclical systemic risk indicator for Malta. And to elaborate more on this subject, I now invite Dr. William Gatfennek, who is the Manager of Financial Stability Research Office, to deliver his presentation. Mr. Gatfennek, the floor is yours.
Good morning. I'm going to talk about the development of the bank's cyclical systemic risk indicator that we've been working on for the past couple of months. This is joint work with Sarah Vella, who is here with us today. So the outline of my talk is as follows. I'll first motivate why we need this indicator in the first place, and then I'll set about how we measured it, because at the end of the day, the construction of this indicator is one way to measure the financial cycle. I'll talk briefly about the signaling properties of this indicator, because that is what we want at the end of the day, its ability to signal about future events. And then I'll have something to say about the indicator within the current context of the high inflation environment in which we are in today. So first of all, to motivate everything, when it comes to the conduct of macroprudential policy, we need time-critical indicators. So as I said, and I'll keep on repeating, we need indicators that can give us information about future events. And to do this, many central banks look at aggregate credit developments. And research shows that doing this, credit aggregates contain early warning properties. So this is a good thing. And in fact, one of the ways in which we monitor credit aggregates is through the use of the Basel gap. For those of you who are not familiar with this gap, this is a measure of the credit to GDP ratio, economy-wide, in terms of deviation from some long-run trend estimated through a process. And if the credit to GDP ratio is above this trend, then the gap is positive and risks could be accumulating. And if it's negative, then it's the reverse. And the literature shows that this has very good early warning properties for several countries, and in fact, it is used in the calibration of the countercyclical capital buffer. However, given the way in which this gap is constructed, sometimes it may not perform as expected. And in the case of Malta, sometimes we are not totally satisfied with the signals that this gap gives, so we set off to develop another indicator amongst the set of tools that we use to monitor risks. At the same time, we also know that there is some information gain to be had when you look at other variables and combine them together, such as house prices and the debt service to income ratio. So this is what we do in this indicator. The cyclical systemic risk indicator, from now on I'll refer to it as CSRI because it's quite a mouthful. I'm going to argue that it's a reliable and a relevant indicator which summarizes Malta's cyclical systemic risk environment. You can read more about this in a box 1 in the Financial Stability Report, which the bank has published, and the more technical working paper will be issued later on this year. So how do we measure the indicator with the aim of capturing the financial cycle? So we set off to build an indicator which has some desirable characteristics. So it has to be specific and relevant to Malta, of course. It must be easy to understand and then communicate. This is really important. And of course, ultimately, it must give timely signaling about the occurrence of future events. So to do this, we draw from a set of relevant risk categories drawn by the ECB and the SRB, and we take variables that draw on credit developments. As I said, these are always important. Some measure of overvaluation, potentially of property prices, some measure of the private sector's debt burden, and also some measure of a country's external imbalances. And so we take many indicators that fall within these different subcategories, and we do a lot of testing to eventually shortlist the amount of variables that enter the indicator, which I'm going to show you soon. To a certain extent, this analysis was limited by the relatively short data span that we have to work with. But I'm going to argue that we still managed to develop an indicator that has good early warning properties. A key caveat with regard to the development of the indicator is that Malta, as you know, had no systemic financial crisis in its recent macroeconomic history. Now, of course, this is good, but when it comes to the development of an indicator that can flag future risks, ideally in your data sample you want a financial crisis in the past to see whether, had you done this exercise in the past, it would have been able to predict. But we cannot do that because we do not have an episode of a crisis in the past. Ultimately, after a thorough search, this is the list of indicators that end up entering the CSRI. So first we have the 2-year growth rate of real bank credit. So real bank credit is deflated. We also use a measure of the house price to income ratio. We take also the 1-year change in the debt service to income ratio, bottom left. And we also include a measure of real total debt, again, in terms of 2-year growth rate. And real total debt here is a proxy for external developments. I have to say that especially towards the end of the sample, some of the data that I'm showing here is still provisional, so the indicator over time could still be subject to past data revisions. But overall, the signal is expected to remain the same. So how do we combine all of these into just one indicator? We use a statistical technique called principal component analysis. I will not go into technical details today, but it's simply a way of reducing the dimensionality of a data set from many variables potentially to just one, which is the CSRI. And the CSRI then, when you build it this way, is going to summarize the most common underlying movements in all of these indicators that I showed you in the previous slide. And so the way it works is that if a variable, any one of those 4 that I showed you, is above its long-term average, then it's going to push the indicator up. And if it's below, it's going to push the indicator down. And the notation for this indicator is that whenever this is positive, the indicator is positive, then it's signaling a rise in risks and vice versa. So these are the weights that we attribute through the method that I described to these 4 subcomponents. So the weights are distributed relatively across all of these subcomponents. So it is not the case that one variable dominates the fluctuations in the indicator, which I'm about to show. And the CSRI, the Cyclical Systemic Risk Indicator, is capturing 63%, around 63% of the underlying movements in all of these variables. So it's capturing underlying trends reasonably well. And this is the indicator for Malta. So the first thing we note from this is that it is cyclical, and the 2 peaks there from 2008 and then again in 2021 are separated by around 15 years, and this is very much in line with the literature on the duration of financial cycles. So this is a first indicator that the indicator is in fact capturing some financial cycle in the case of Malta. I'm showing also the composition, so the drivers of this indicator at different points in time. I'm not going to go through all of the history, but I'd like to draw your attention to the recent past. So you will see that the indicator started to rise after 2020, and the rise there was broad-based in the sense that all of the subcomponents are pushing the indicator up, which indicates an accumulation of risks. The yellow bars there, which are for total real debt, capture also the increase in total government debt, and I'm sure, as you all are aware, because of the pandemic and other events that followed, government debt rise, and that is therefore pushing the indicator. But when we interpret this indicator, we are well aware that some of the contributions there are due to one-off events. So we take this into account when interpreting the indicator. I'd like to draw your attention to the last data point, because so this indicator then started to fall, and in the last data point it actually turned negative, which starts to indicate a decumulation of risk. So risk could potentially still be high, but a decumulation of risks. I'll have something to say about this later, because you might note that the 2 contributors to this negative data point are real bank credit and real total debt. So variables which are being deflated somehow, stripped away from the effect of inflation. And I'll come back to this shortly. But I'd just like you to keep this in mind for now, please. What I'd like to move on to next is on the signaling properties, the potential for this indicator to tell us about what's going to happen in the future. And what we really care about at the end of the day are the consequences of these risks, and we're going to proxy them by their effect on future GDP growth. So the question we ask is, what is the effect of a rise in this indicator today and implications for future economic developments? So there's an indicator, similar indicator for the euro area and several countries, and an exercise was done to answer this question for the euro area, and the results are, by Lang and co-authors, that for the first few years, nothing really happens, so the indicator rises today, but for the first few years, we observe no material impact on GDP. But then within 3 to 5 years into the future, we observe a peak reduction in GDP growth of 4 percentage points. So a rise in the indicator today for the euro area as a whole can indicate a further, a future reduction in GDP growth and economic activity due to the rise and materialization of risks. And what is the story for Malta? Well, through the CSRI that I've showed you in the previous slides, the story is very much the same. So we observe no material impact on GDP in the first 3 years following an immediate rise in the indicator, but we then observe a peak reduction of around 1 percentage point in Malta's GDP growth 4 years into the future. So the profile is very similar to what we observe across the euro area, but the magnitude is much lower, of course, because historically, as I said, we had no financial crisis. So this is to be expected, and this makes sense. The only thing I will say at this point is that this estimate is subject to a lot of uncertainty because we're working with a short sample. The estimate for the euro area is based on a longer time series, and therefore there is a bit more certainty around the estimate. But nevertheless, it gives us an indication that the indicator should in theory perform as we expect it to perform. Finally, I'd like to say something about the indicator within the current context of high inflation. So as you know, both in 2022 and 2023, inflation is still projected to remain high. And 2 of the 4 components that enter the indicator, you might recall, are real bank credit and real total debt. So these are being deflated by HICP in this case. And one concern we might have here is that the very high HICP inflation we are experiencing currently could be masking risk developments because we are deflating variables from nominal to real. So we want to assess to what extent this temporary high inflation could affect the conclusions that we draw from the indicator. So theoretically, we agree that debt should be deflated because what really matters is the real burden. But nevertheless, given this temporary environment of high inflation, we want to ask to what extent is this risk assessment potentially being dampened. So what we do a simple exercise. We recalculate the indicator that I showed you, but this time using data in nominal terms. So bank credits and total debts are not going to be deflated by HICP. We're going to keep the weights the same, and we're going to compare the indicator based on real variables with the indicator based on nominal variables. And this is the result. So we so I'm plotting here the indicator in real terms, which is the one in teal, which is the same indicator I showed you a couple of slides before, and I'm superimposing the indicator based on nominal variables. So the first thing we notice is that throughout most of the sample periods, these 2 indicators overlap qualitatively and sometimes even quantitatively. So historically, it doesn't really matter, at least at first glance, whether you deflate or not variables. The risk assessment is still unchanged. However, towards the end of the sample, when inflation started to rise high by historical standards, we see a divergence between the indicator expressed in real terms and the indicator in terms of nominal terms. And this is why earlier I flagged the last data point, which turned negative, because that is really being driven by this recent high inflation outturn. If we control for that, the indicator based on nominal terms is still high. So this is important for the conclusions that we draw on this risk assessment using this indicator. Okay. Nope. Thank you. So to conclude, today I presented an indicator that can flag cyclical risks preemptively, as we would like it to be, and considering several factors, so therefore not looking just at credit developments. I want to emphasize at this stage that we do not intend to apply this indicator mechanically, but of course the role of judgment remains very important, and also cross-checking with other indicators, as the Chief Officer presented earlier, remains still a very important task. Nevertheless, the development of this indicator complements the toolbox that we have at the bank, and I'm happy to say that we are developing even more models to aid further in this assessment. So what do we take from all of this? The bottom line is that the recent rise in risks, so far at least, appear to be contained, yet they warrant continued monitoring for 2 reasons. First, Given the recent bout of monetary policy tightening, the extent of pass-through to the local economy could have implications on debt servicing. Debt servicing is one of the variables we use in the indicator, and that could potentially push the indicator up. So we need to remain vigilant and monitor this. The second point that warrants further monitoring is the role of inflation in squeezing household financial margins and therefore their ability to keep up with debt payments. So although the risks so far appear to be maintained, we urge continued monitoring in the near future. Thank you.
Thank you, Dr. Gatfenek, for a very interesting presentation. Now, during this year's seminar, we will have a panel discussion to treat a very topical issue of conducting macro-prudential policy in a tighter monetary policy environment. We are happy to have with us today Dr. Carsten Dettgen, who has traveled all the way from the European Central Bank to be with us, along with the rest of the panel speakers. And now I would like to invite Dr. Robert Suban, Head of Department and Senior Lecturer at the University of Malta, who will be moderating this session.
Good morning to everyone here. First of all, I would like to thank the organizers of this event for taking such a big effort in order to organize this event and especially to try to promote financial stability, which is a very important function that central banks conduct today. And most of the time, this is not a function which is very well publicized. So obviously, everyone knows that central banks are in charge of monetary policy, but nowadays, and especially given the recent events that we've seen earlier this year, we now realize the importance of financial stability. I would like to introduce all the panel members here. So I'll start from the far left with Mr. Marcel Cassar, who is here representing the Malta Bankers Association. And he also happens to be the CEO of APS Bank, one of the core domestic banks. But although here he will be expressing his views, I presume, as the Malta Bankers Association president. Then Ms. Christine Balzan, here from the Central Bank, who is the manager Policy Crisis Management and Stress Testing Department. And then Dr. Carsten Dettgen, from the European Central Bank, who is the head of the macro-prudential policy division of the European Central Bank. And then Ms. Rita Schembri, who is the head of the economic analysis department here from the Central Bank of Malta. So I would, given the presentation on the financial stability report, I would like first to start by asking a few questions to Ms. Christine Balzan. So we listened to the highlights of the financial stability report. Could you please tell us, in practice, how is the risk assessment translated into the design and implementation of macro-prudential policy?
Right. So we've heard a lot of information this morning from the presentations by my colleagues, as well as the keynote speech by the Honourable Minister. So I can put all of this into the context of macroprudential policy. So in the implementation of our macroprudential policy strategy, we follow a four-cycle process. Initially, we start with risk assessment. This is the first important element. So we have a number of frameworks, one of which was the one that was discussed by my colleague, Dr. William Fenech, GAT. We look into the development of a number of macrofinancial and other financial stability indicators as part of the early warning system. The idea is, of course, to look into also the risk outlook and any near-term headwinds for the financial system. This analysis is then complemented with our stress testing frameworks. We have a number of frameworks as part of our stress testing toolkit, where we test for a range of risks, be it liquidity, credit market risk. And our stress testing frameworks are updated frequently, both the scenarios that we test for as well as the shocks that are applied in line with prevailing conditions. As also Mr. Ellen Kassar mentioned, it's important to note that stress tests are not forecasts. Stress tests, the idea behind stress tests is to test or shock the system against extreme yet plausible events, but by no means these are to be considered as forecasts. Our assessment is also complemented by other market intelligence and qualitative assessments. We carry out surveys. At times we have discussions also with our stakeholders and with market practitioners. And at times we also request specific data requests, although we try to limit this to the extent possible, because we acknowledge the burden that this can have on banks. The second step would then be, so after the identification of risk, the second step would be to determine whether policy action is required. So in that instance, we consider whether the risks are transitory in nature, because not all risks have the potential to become systemic, and banks might be equipped also to withstand some of the risks. So we only target those risks which we deem to be systemic, and also we need to look into whether banks have enough room for maneuver, so whether they can absorb the additional capital buffers that we request. Then, as a third step comes which policy tool. So, because we have a range of policy tools at our disposal, one example perhaps I can draw from is the recent implementation of the sectoral systemic risk buffer, which was introduced earlier this year and which banks now in September have to start holding. There we determined that there were specific risks arising in the residential real estate sector. So it was the sector that we wanted to target. So other policy tools, such as, for example, the counter-cyclical capital buffer, was in the right policy tool. So hence the implementation of this buffer. And that also entails the calibration of such buffers. So we have frameworks in place, although this is something which we need to develop further, both domestically and also at the European front, when it comes to policy. That brings me to the fourth step, the final step, which would be policy evaluation, because we need to determine whether the policy action, whether the course of action that we have taken was adequate enough to or commensurate with the risks that we would have identified. So we need to determine whether the policy action that we considered has mended the risks that we has addressed the risks that we had identified.
Okay, thank you very much for this answer. You just mentioned the introduction of this new systemic buffer. In fact, during the presentation of the financial stability report, it was mentioned that the banks in Malta, and I think Europe-wide, but obviously here we're talking about Malta, their profitability has been recovering. So normally, during this time, there is always a call for increasing buffers. So in your opinion, is this a good time to activate such buffers when the macroeconomic environment is still somehow uncertain?
Well, let's start with the why we need macroprudential buffers. So we need macroprudential buffers in order to maintain a healthy financial system. Financial stability is conducive also to price stability. So maintaining a healthy financial system is critical. We have seen this, we have experienced this in the most recent crisis, where our banks were more equipped than they were in the 2008 crisis. Their capital buffers were more healthy. They had in place more releasable buffers. We were mindful as well on the impediments to buffer use. They had better asset quality than they had in 2008. And this thanks to the efforts during the past decade, let's say, on the non-performing loan front. So why macroprudential policy is important, I think we have experienced it quite recently. Whether it's time to implement policy during uncertain times, there isn't a direct answer because this is based on a number of considerations. One of them is to determine at which point on the economic and financial cycle we are performing, the risk outlook, the extent of capital buffers of banks. As I said, it's important that they are able to withstand the capital buffers that we are implementing. So there isn't a direct answer. There are a number of factors to consider. But I think the key message here, what's important, is that during uncertain times, it's important that we continue to preserve the stability of the financial system. So if policy action is warranted, then policy action is to be implemented. One other factor which comes to mind is timing. Timing is critical as well, because too early intervention or too late intervention can have its costs. But I think during uncertain times, still it's important to preserve. It's not the time to be complacent or to be lax, but macroprudential policy, yes, the implementation of it is still warranted. And a typical example is the implementation again of the sectoral systemic risk buffer.
Okay, thank you very much. I now turn to Ms. Rita Shkembri. Another very fairly recent, although now we're talking a bit more than a year, very important development has been the increasing interest rates or the monetary tightening. And here I would like to ask your views about how does the ECB assess the potential trade-offs between monetary policy and macroprudential policy, and how are these decisions aligned with the ECB's overall policy objectives?
Okay. So I will start with the usual disclaimer here. So this will be my personal view without prejudging what the Monetary Policy Committee, the Central Bank of Malta, or the ECB thinks, and based also on an interpretation of what I've seen, especially during the discussions of the strategy review. So although the treaty is clear on the primacy of price stability objective, this does not mean that monetary policy should not take into account financial stability considerations. First of all, the treaty obliges the ECB to contribute to the policies of the prudential authorities as well as financial stability. But apart from that, the ECB also has an obligation to support policies that contribute to the broader objectives of the EU, like employment. But beyond these legal considerations, as many speakers have already mentioned, the transmission of monetary policy depends on sound banks, sound money markets. And so without this soundness, the ECB will not be able to deliver price stability. In fact, it is also fair to say that since, maybe not since the beginning, but since the early times of EMU, financial indicators were always part of the information set that the ECB considers when deliberating on monetary policy, and this probably contributed to limit conflicts between the two policy areas. And actually, over time, that analysis has become more sophisticated, and there is an effort now to integrate the financial stability aspects more fully in the monetary analysis. On the issue of trade-offs, in the end, the two policy areas should be complementary, because if you have sudden swings in interest rates, you destabilize the financial sector, but likewise, if you have financial exuberance or financial stress, you amplify the economic cycle. In the short term, however, trade-offs can exist, especially because the economic cycle and the financial cycle are not synchronized. It's very difficult, as was stated already, to know exactly where you are along those cycles. And within the euro area as well, there are heterogeneities across countries. So it's very unlikely that the single monetary policy will address the specific circumstances of every country. And as we know, monetary policy has a euro area orientation as well. Now, how to minimize those trade-offs? First of all, I think micro-supervision is the first line of defense. So if the micro-supervisors do their job well, the scope for trade-offs should be more limited. But apart from that, I would also say that the choice of tools that we have is important. So the more tools that the monetary policy and macro-prudential authorities have, the better it is. In fact, there is some evidence also from the low interest environment where it was found that combining asset purchases with the negative interest rate policy actually limited some of the side effects. And also it's important to have instruments that can be easily calibrated as we learn, as we go along. So for example, in the case of TLTROs, the design was important because by excluding housing loans from TLTROs, the ECB in a sense limited the chances of a housing market bubble. And apart from that also, when we realized that the low for long was becoming problematic in terms of the net interest income, the tiering of the remuneration of excess reserves also helped limit the side effects on the income of banks. So this ability to adapt is very important. And then we must also not forget the medium-term orientation of monetary policy. Now, there has been a long debate on whether monetary policy should lean against financial stability considerations. But the fact that we aim to achieve 2% over the medium term offers us, I think, some space to take into account financial stability considerations. Now, the problem is the starting point. So for a central bank that has been away from the inflation target for quite some time, it is very challenging to accommodate, in a sense, financial stability considerations, because it might give the impression that we are not committed to our primary mandate. And another challenge is how much the public and markets understand the reaction function of the central bank, because if that is not well understood, it can lead to time inconsistency problems, challenges with communication, and also an unanchoring of inflation expectations. And if that happens, the central bank might have to respond more aggressively down the line with significant repercussions both for the financial sector and for the economy. If I were to sum up maybe the Eurosystem thinking, but from my perspective, it's that macro-prudential policy should be the first line of defense against financial vulnerabilities, and that should allow monetary policy to focus on its job, which is to control inflation. However, because of the importance of financial stability for monetary policy, the former cannot be ignored. At the same time, to account for it, accounting for it has to be done in a flexible way and not in a mechanical way. And finally, the central bank, in its monetary policy deliberations, should be mindful of potential side effects it can have on the other policy area and try to mitigate them as much as possible, which would also be in line with the proportionality principle embedded in the treaty, not to do more than is necessary.
Okay, thank you very much. During the low for long interest rate environment, macroprudential policy tended to correct for perhaps excessive risk-taking from banks. Do you think that now that the environment has changed, the interest rate environment has changed, that macroprudential policy can be a complement to monetary policy? What do you think about that?
I think it depends on what we think by complementarity. So, for example, during the pandemic, all the main policy areas were complementary in the sense that they were moving in the same direction to preserve economic structures and limit disinflation. In this case, when macroprudential policy was tightening while monetary policy was very accommodative, I would say it's more a case of one policy area is trying to offset the side effects of the other. But the fact that most of the tightening in macroprudential buffers, macroprudential policy was then maintained even during the war, at least in the euro area, probably some complementarity was achieved there in the sense that without those measures, inflation would probably have been higher. So, of course, inflation has been very high and persistently so, but if you think about in terms of a counterfactual, we'd probably have been in our situation. Now, the current tightening cycle, I would say it's uncharted territory. First of all, we had a very fast increase in policy rates. So in just about a year, the policy rate increased by over 400 basis points. By comparison, if we look at the previous tightening cycle, it was half as much, more or less, and it took place over a longer time period. And of course, economic and financial structures have changed since then, and we also know that the role of non-bank financial institutions have increased, although banks remain, the euro area remains a very much bank-based system. Now, transmission in the euro area is unfolding, and it's unfolding in a forceful way at a pace that is faster than one would have expected on the basis of past regularities. But unlike in other jurisdictions, we haven't seen the significant stresses, so it's proceeding smoothly. Said that, the process is not complete, so even if policy rates were to remain at current levels, it doesn't mean that we won't see the effects of past decisions down the line. And it was mentioned, and I agree that typically when interest rates increase, the net interest income of banks improves, and this is especially the case for banks who are rich in liquidity, because mechanically they earn higher remuneration on the balances they hold with the central bank. But we must also not forget that the tighter interest policy sets in motion other challenges that maybe are not so favorable for the banks, and that includes slower activity, which therefore tends to translate in lower asset quality, and also lower demand for credit, so lower volumes on which banks can earn a margin. At times, and we've seen it in other jurisdictions, you can have significant fire sales, for example, of assets, and as liquidity gradually drains from the system, you can expect wholesale funding prices to increase. So even if we don't, if we have been sheltered to some extent from these forces, it doesn't mean that we won't see them down the line. Maybe on a more positive note, inflation is coming down now, so it's still very high. The disinflation process is slow. We're seeing it more clear on the headline inflation than underlying inflation. But even if you look at the latest inflation projections, in 2025 now we are just marginally above 2% in terms of HICP for the euro area as a whole, and the risks are more balanced than they were before. On how macro-prudential policy should respond, I think I tend to agree with Christine. So the fact that the transmission process has been orderly makes it very difficult to argue for a relaxation of macroprudential policy. That space should be preserved for when the next crisis comes, especially in a context where the fiscal space of governments is not what it used to be. Maybe the issue of whether macroprudential should tightening is more of a gray area. There is a risk that after a succession of rate increases, you risk overdoing it. In a sense, you risk achieving deleveraging forces which are beyond what you want to achieve to lower inflation. At the same time, there could be scope for, I see two cases where there could be a tightening in macroprudential where it might help. First is in jurisdictions where the transmission of monetary policy is lagging behind, and in cases where the existing macroprudential measures maybe are not sufficient to address the vulnerabilities at hand. But in any case, it would have to be a very targeted and well-timed response.
Okay, thank you very much for this very detailed answer. You touched upon a number of points, and probably we'll have the opportunity to come back on those, especially when talking about developments here in Malta. But I would like to turn to Dr. Detkin here and ask him a bit what he thinks about this similar question. So the fact that during this very long period of very low inflation and very loose monetary policy, macroprudential policy was complementary. And what do you think now that the cycle has turned and now we are seeing these very high increases in interest rates?
Okay, let me just start with a disclaimer, similar disclaimer that my views here are not necessarily those of the ECB. I don't say the views are orthogonal, but again, not necessarily the same. And let me thank you also the other organizers to let me participate in this very interesting discussion. Indeed, I think it's a legitimate question because, as was said before, we had in the times of low interest rate, of low for long period, macroprudential policy was tightening towards the end of it to counter some of the side effects or potential side effects of this low interest rate and very accommodative monetary policy environment. So the question is really legitimate. So if the policies compensated each other and were kind of substitutes in a sense, then now when the monetary policy is tightening, why not loosen macroprudential policy? And potentially this could allow monetary policy to tighten more decisively. So the logic is not it could be there, no? But I think it's wrong, like other speakers here already mentioned, and it's wrong for I think at least 5 reasons at the moment. So one is one should really focus in terms of macroprudential policy. One should focus on the resilience aspect, not the cyclical aspects. Right? Although at the beginning of the macroprudential policy thinking, also in Europe, perhaps 2014, when the ECB got these responsibilities, perhaps at the beginning it was more 50-50. There were people, macroprudential policy should smooth the financial cycle. But I think nowadays there has been a transition of thinking, which is gaining traction, that no, let's not exaggerate here. Let's not try to fine-tune the financial cycle. Let's really look at the resilience. Let's look at the vulnerabilities which are out there, and then try to use these new instruments to maintain resilience or to increase resilience of the system. And so if we see still vulnerabilities out there, in most countries in the euro area, it's related to indebtedness of households, indebtedness of companies. So if we still see these vulnerabilities, then let's maintain the resilience. Let's not give away the buffers we have been meticulously building up. So that's the first argument, really focus on the resilience. Second, we have to see that you could argue monetary policy tightening would reduce some of these vulnerabilities. For example, house price overvaluation might be diminishing due to the monetary policy tightening. But the evidence shows that this is going very slowly. So it's not from day one that we start tightening that these vulnerabilities are gone. So it will take time. Third, and this was also mentioned in the previous presentation actually, if you look at these risk indicators, with high inflation, the risk is that you underestimate existing risks. Because high inflation, indeed, you immediately think about it's reducing the real debt. So that should be something good, and you see that in some of these indicators. But no, I mean, the other problem is, of course, that disposable income is reduced, so you add to vulnerabilities. And there's also evidence that some of these relatively similar indicators which was presented to us when they start declining, that's often a sign of risk materialization in the nearer future. So let's be careful here. Despite the fact that we see these risk indicators coming down, let's not be too complacent. Fourth argument is the procyclicality. Some, of course, people argue, my God, the financial cycle is turning, and it definitely is turning down. So you have to release these buffers, otherwise the debt would be procyclical, and you add insult to injury here. But that is not the case. I mean, the banking system in Europe has so much capital space. On average, we have 4 percentage points above requirements, in Malta even more. So there's no risk at the moment that these measures are pro-cyclical at all. And finally, last argument, the stimulation, I mean, you would need to be convinced that if you release existing buffers, that this would stimulate credit demand, if you're concerned about the downturn of the cycle. But if it's not credit supply from the banking side, if it's not capital requirements which are prohibiting the credits, but it's actually credit demand, because people are becoming more risk averse, they see less investment opportunities, then a release of such buffers would do nothing to stimulate demand. So it would be a completely useless measure. So for those reasons, I fully agree with the fact that in this part of the cycle, we should not release the capital buffers.
Okay, thank you. Obviously, it is clear from the treaty, and when I listen to President Lagarde press conferences after monetary policy decisions, she always reiterates this primacy and the goal of low inflation. Obviously, since there has been the banking union and the single supervisory mechanism, obviously this macroprudential policy has been added, so to speak, to the job of the ECB. So how do you see the ECB tackling this dual role? And in particular, how do you see the ECB cooperating with the national authorities and looking a bit at the situation of the banking markets in the individual countries?
Okay. For the dual role, I would give you three explanations. Indeed, it's not necessarily it's not the only way to organize things. No? To have the central bank also being in charge of macroprudential policies. But why is this the case on the euro area level? There's a legal, an economic, and a political-economic explanation for this. Legal explanation is that at the time, we got this responsibility together with the SSM regulation when the ECB became banking supervisor. In line with that came also the macroprudential responsibilities. And this was at the time just the fastest way to do it. Because in the treaty, in the Maastricht Treaty, there was this possibility foreseen that the ECB would become banking supervisor. And at the time, it was considered that we would need to organize this at European level quickly. And then this was done. The ECB got micro supervisory tasks, and along came the macroprudential task, because we saw in the previous, more recent past with the great financial crisis that indeed macroprudential perspective was missing from the supervisory actions. So that's the legal side, why it happened. But there are good economic arguments also why this is the case. First of all, monetary policy and macroprudential policies often work through the same transmission mechanism, via bank credit, for example. And there is expertise in central banks to analyze the transmission mechanism, to analyze the importance of the banking sector, financial sector for the macroeconomic outcome. So in a sense, it's efficient to have those people also look to analyze these issues in unison. And there's also a certain need for, let's say, a minimum harmonization or level playing field. I mean, macroprudential policy was new for Europe in 2014 at this scale. And while being very clear here, and I come to this in the second part of your question, that the national authorities are the first in line to be responsible for macroprudential policies. But some minimum harmonization. We use, for example, we use the same concepts of what is excessive credit growth. Which series are you looking at? Do we have a framework on how to think about what is excessive, what are risks. I think that makes sense, that there's also some center kind of coordinating the effort to, again, at a minimum level, harmonize concepts and frameworks. So I think that makes a lot of sense. Finally, there are issues with potentially cross-country spillovers of macroprudential policies. You might also affect, also due to reciprocity of some of the measures, you might affect not only your own country, but also your neighboring countries. And so it's good to have somebody looking at this perspective as well, while national authorities, perhaps sometimes they're busy really analyzing the effect on their own country, legitimately so. Perhaps finally, yes, if macroprudential policies are, as was mentioned before, the first line of defense against building financial vulnerabilities, sometimes there might be situations where monetary policy has to be the last line of defense, as a Fed governor recently said. And I would agree to that. I mean, if macroprudential policies are not effective, if they're not implemented, perhaps at some point you might take into account the interactions with monetary policy. So it's good to have it, let's say, in-house, both types of analysis. And it's not by coincidence that the Governing Council in the end decided that the macroprudential policy analysis and policy function at the ECB is on the central banking side. So despite the fact that it came with the SSM regulation, we are sitting with the monetary policy, in the monetary policy building, not with the supervisors. Then the third category, the political-economic reason, very quickly, why this is the case, why we have this dual role. There was, I think, from the legislator, the fear that there might be policy inaction on the sides of the national authorities. Because in an integrated financial market, in an integrated banking market, in the past we have seen supervision being sometimes a bit reluctant, because of course you see your banks in competition with other banks in the euro area. And that's why our powers are asymmetric. We can only work towards tighter requirements, so higher capital buffers, for example, and we cannot lower requirements. Why? Because the legislator had the fear, okay, in case there is national inaction bias, we need a center to potentially counter this and push things going forward. So these are the three reasons why I think, to me, it makes sense that there's this dual role. And very quickly on the cooperation. So it's a shared responsibility. I think that's fair to say. Macroprudential policy is a shared responsibility between the national authorities and the ECB. As I said, national authorities are first in line. They have also much more resources, know the data much better, know the situation much better. So they're clearly first in line. Our comparative advantage is a bit a peer comparison. So the way we analyze things is we compare countries across the union and compare the situations, and also by means of a lot of models, quantitative tools, so that we get sometimes the information, okay, but we can confront the national authorities and say, listen, history says, if I compare it across time, a country in your situation in the past, in 80% of times, got into trouble 2 years later. So why are you not doing anything? So this peer comparison perspective, this is a bit where we act and where we then can start a very fruitful dialogue with countries. Not everybody, I can also be honest, not all countries appreciate our role. Or let's say the appreciation varies a bit. We have very good interaction with the Central Bank of Malta, which you see by the fact that I'm sitting here. And, they even invite somebody to the FSR presentation from the ECB. But again, overall, I think it's a very fruitful discussion process. There are various committees where the issues are discussed, and we try to come to a common conclusion in the end.
Earlier on, the governor in his introductory speech mentioned the events that happened earlier on this year during March, and referring to the failure of a number of American banks. which were struggling with the fast increase in interest rates, because normally it's not just increasing interest rates, but when the pace of interest rate increases are extremely high, that creates potentially problems for banks. Do you think that this tighter monetary policy is contributing to higher financial instability or financial stability risk in Europe? And if that's not the case, to what extent are we different from the USA?
Yeah, no. So I think we have to to face it. A period of rising interest rate, and as you mentioned, very swiftly rising interest rate, it can create financial stability concerns, because either the borrowers of the bank might face trouble, especially if you have more flexible rate loans, or we see something like what is called interest rate risk. If you have mainly fixed rate mortgages on the banking books, then you have the banks being locked in and receiving low interest income, while their funding costs might rise. This might reduce profitability and potentially lead to deleveraging and less credit provision. So, in theory, these risks are there. We cannot deny it. No? So, and there's also research out there showing that indeed periods of swiftly rising interest rates can lead to problems in the financial sector. So in general, I think we cannot deny this fact. In practice, in this situation now, one really has to acknowledge that Europe is very different from the US indeed. We have seen, and we've seen that, for example, in the recent stress test results. This was really a very severe scenario. Over 3 years horizon, there was a depletion on average of, I think, 4.8 percentage points of core equity tier 1 capital, ending up after 3 years of severe stress still on the average at that 10 percentage points of capital. So banks would be really comfortable seemingly to withstand a scenario which included severe also increase in interest rates. So this was a severe scenario in this exercise. So that's one thing which is comforting. The other thing is we also published, by the way, this is on the ECB webpage, an exercise on looking at the unrealized losses. So because that's something which was the case in the US case, that the moment depositors start running from the bank, then also the assets you hold as a bank, which in the end you will hold to maturity in principle, but then you might have to sell it, and you have forced asset sales. And so then the interesting part is, okay, so how much of these losses are really unrealized and would only materialize if you have to sell? So we looked at this and compared this to the US, and I think the data from February showed that we would have something like, for the euro area as a whole, 73 billion of unrealized losses for all banks together, while in the US, I think it was 500 billion. So different order of magnitude. And even in a severe stress scenario, the one which was tested in the exercise, there would be an additional, I think, 155 billion of unrealized losses. But of course, if that would materialize, bank could also go to other sources first to get liquidity. They didn't need to sell that necessarily. So I think all these exercises show that we're really in a different situation, and we can be relatively comfortable that there's no catastrophe on a broad scale happening. Of course, you never know. There might be individual banks which run into trouble, but not on a big scale. And that's also, I think, why Lagarde has been stressing recently several times that there is no trade-off. No, we will do whatever needs to be done to maintain price stability. We're looking at the financial stability implications side, but we're not concerned that this constrains us in the monetary policy actions at this point in time.
And if I may add to this, zooming in the Malta case, as well, we have been testing for this, and we have been asking questions whether there could be instances in Malta which would lead to a similar SVB case. But our banks have strong liquidity positions. They have most of their instruments, as Mr. El-Inkassar mentioned, at held to maturity in terms of measurement. So the level of unrealized losses in the case of our banks was not that significant. Not a lot of banks have registered significant losses. Our instruments are also eligible for ECB funding, so that means that, again, the need to resort to the market and to engage in fire sale prices is minimal. But this test, let's call it a test, it has set us thinking into a different dimension, because the SVB case was considered as the first ever digital bank crisis. So this is something which we are looking into in our scenarios, because as I mentioned, we update our scenarios frequently in line with prevailing conditions. So we need to think how much banks are prepared to under this kind of scenarios. A bank run nowadays can become more intense and much faster because of the availability of social media and the quick access to funds. So the so-called digital bank run and also the digital currency has set us thinking into ways how to test banks' ability to withstand these kind of losses as well.
Thank you. Now I turn to Mr. Kassar and the practitioners here in Malta. So perhaps before I ask you a number of questions, maybe you could give us a bit of your opinion regarding this digital bank run and the possibility of actually customers using mobile banking or internet banking to, I think in the case of SVB, in one single day, they had a 25% deposit which went out, which was obviously quite an extreme event.
Okay, thank you. Thanks, Robert. I won't make a disclaimer, but I will just explain that I'm representing the Malta Bankers Association. But however, when I make some specific references to particular situations or particular, let's say, decisions, I would probably be more referring to my own bank, where I have more visibility. Of course, I can't speak for all the member banks of the association. And again, when I speak of the association, perhaps more relevant to today's event and to the scope of the Financial Stability Report is the role of the 6 core domestic banks, of which 4 are systemically important. So I think this clarification is also important. Yes, SVB was quite a story, quite an experience. Probably one of the, I think it was the second largest failure now after Washington Mutual. But when you analyze it, it was also probably one of the simplest to understand. It wasn't only a failure of rising interest rates or an unintended consequence of rising interest rates. I think it was also a failure of regulation and supervision, because the blatant failures of governance and lack of management and risk controls, just to think that they had been without a chief risk officer for I don't know how many months at least. So it was also a failure of governance and supervision, which was perhaps, at least to me, one of the most striking aspects as to why this was happening in 2023. The lesson learned from the digital bank runs, as Christine very well described them, is that something has to develop which will not allow them to happen again. And I want to share with you, in my other role, sitting on the board of the European Banking Federation as a result of being the chair of the MBA, at a meeting we were having only a couple of months ago, earlier this year, in Stockholm, there was a presentation about the introduction of, let's call them circuit breakers, whereby digital banks in particular will not allow such, let's call them digital runs or digital withdrawals to happen in such an uncontrolled way. I think that is a key lesson that must be learned from the SVB case because it can happen, and it can happen again. And I think the technology which facilitated the growth of SVB and the concentration which it developed, the technology should also facilitate the necessary controls not to allow such a drain on the bank, which actually crippled it in a matter of 48 hours.
Thank you. We've been hearing about quite a number of macroprudential policy measures. From your side as a practitioner, do you think that these or some of these macroprudential measures can have a potential for unintended consequences that maybe regulators should be aware of?
Yes, take SVB again. I think it's a perfect example, but let's go a bit beyond it. Let me go back 15 months, which is when we were seeing the first interest rate increases by the ECB. Maybe I speak for myself and I speak for my bank here as well. But it made me go back to some research and to some literature to remind myself, how do you run a bank in times of rising interest rates? And in fact, I even organized an offsite for our senior management team. How do you run a bank in times of rising interest rates? Because it needed a totally, I would say, fundamental shift in thinking. It also needed education. It also needed information. Even a cohort of a generation of people who were not familiar with such an environment. So it needed some settling down and some alignment of understanding and of interpretation. The unintended consequences are that at the time we did not have a good visibility as to for how long these hikes in interest rates were going to continue. The first 25 basis points, and then the next 50 basis points. How long were they going to continue? How intense and enduring were they going to be to bring inflation under control? So even when it came to the planning and to the strategic direction we would be looking at for 2024, how do you model all this? How do you forecast all this? So the unintended consequences were probably not the first thing on our mind. I remember even being interviewed at the time or having our own internal talks and discussions in management. We used to say, rising interest rates, everything else being equal, should be good for banks because traditionally banks make better margin when interest rates are on the increase. But yes, there are unintended consequences, and I think the most obvious one is to what extent will they have to rise to start to create pain on your borrowers? And what kind of risk appetite should you develop, or how do you redefine, or how do you review your risk appetite for a period of rising interest rates? Already mentioned SVB and the positions which banks held and hold ultimately as a liquidity management tool, whether those securities are held to maturity or measured as available for sale or for trading. But I think there is another important, let's say, unintended consequence, and this has been referred to directly and indirectly by my other my colleague speakers earlier today. And this is that the pass-through takes its time. I think only maybe a couple of weeks or days ago, I was reading from the statement made by the chair of the Financial Stability Board, Klaus Knott, who was saying that the challenges and the shocks ahead will come because it takes time for the effects of the pass-through of the rise in interest rates to work its way through the strengths and also through the vulnerabilities of the different banking system. Now, maybe, as my concluding remark on this, and looking mainly at Europe, we are looking at a banking system that, yes, is resilient, is in much stronger shape than it was ever before. No comparison to the aftermath of the 2009 crisis, despite the fact that the system was still trying to come out of the recovery from COVID. But still, there will be, and the EBA stress test has proved this. The EBA stress test has proved once again, recently published only a few months ago, proved that there is resilience in the banking system. However, I think there still needs to be time given to see what the filtering effect of the pass-through will be. We've seen good ratios in terms of NPLs, in terms of also of the total capital ratios. Even if we look at our system locally, those are the really highlight results coming out from the Financial Stability Report of 2022. But there still needs, I think, more time to see, because there will be some challenges ahead that need to be overcome.
Thank you. I will come back on this issue of pass-through, but first, obviously the whole philosophy of the Financial Stability Office and all these measures is always to call for prudence and to be prudent. Obviously now that as we have seen earlier in the report, that banks' profitability has been increasing and obviously helped by higher interest rates, obviously shareholders and investors normally call a bit for perhaps trying to maximize profit. So how do you see the managing of these two issues, the need for profit maximization while maintaining prudence?
I had to drink a sip of water to prepare for that one. Good question. I think I will start by answering that by reminding what regulators remind us of as well, and this is something which the MFSA and the central bank echo, coming also from the SSM and from the ECB, that banks are expected to run profitable business models, not just prudent business models, but also profitable business models. So profitability is also on the mind of regulators, and this is important even for bankers to be reminded about, because the cycle is long, but still it is a cycle. Ultimately, running a profitable business model is what rewards shareholders and what gives confidence to investors and to shareholders that when you turn to them for capital, they will be there to respond. And banks had to turn to shareholders for capital quite a few times in the last decade or two. And ultimately, they will turn to shareholders for support again to remain solvent and to remain well capitalized. Now, finding and striking the right balance is always a difficult task. What I will say is that banks are licensed to extend credit to the economy, and not to be run as treasury portfolios. One of the interesting findings from the report, which did not come by a surprise because it's a well-known statistic, is the very high LCR for the Maltese banks, just under 400%. When you think that the minimum is 100%, so 400%, it means that there's a lot of liquidity on which the banks are sitting. And again, one would expect that there is more interest in credit activity, which the banks would have been looking at, especially in the post-COVID economic recovery. I think it's also important that macroprudential policy is not seen as being something that rewards banks that are slow in extending credit to a recovering economy. Of course, always within their different risk appetites. One other point of, let's say, striking the right level of balance between being prudent and being profitable is a ratio which we don't typically look at for a number of reasons, and that's the loans to deposits ratio, which in an environment where the ratio is high, and in Malta the average ratio is on the low side. It's much less than it is in the rest of Europe. Let's say the average in Malta is around 60%, whilst for the EU it's around 100%. There is more pressure on fundraising when loan-to-deposit ratios are high, because banks have less space, less capacity to maneuver with their funding, whilst there is less pressure on fundraising when the loan-to-deposit ratio is low. And this is also another interesting, I think, phenomenon which we're seeing developing in Malta between the different banking models. The banks that sit on massive liquidity and low loan-to-deposit ratios find that they are under less pressure to raise funding than the banks that operate on a higher loan-to-deposit ratio and on a, let's say, a more manageable LCR. But there is an interesting also development which has now come out very clearly in the second half of 2022, and we're seeing it also in 2023, and that the banks now have a new important competitor when it comes to fundraising, and that is government. We did not have government before as a competitor, but now we have. Even investors, even traditional bank customers and depositors now are looking at instruments that are government liquidity instruments, which probably they had forgotten about. I had to remind colleagues of what are treasury bills, for example, because probably everybody had forgotten about treasury bills now for almost a decade, but now they're back in fashion.
In fact, to touch upon this, you just mentioned treasury bills. It's very interesting that the rate on treasury bills has actually been going down. Until a few months ago, you could invest and get 3% plus 3.5%, and now it was more around the 2.5%. Partly of this excess liquidity being directed towards these instruments. In fact, the Malta treasury bill rate is actually lower than the one for Germany, for example. And in fact, you also mentioned this very low loan-to-deposit ratio. Perhaps that also explains why we have a very low pass-through of these higher interest rates here in Malta.
This thing of pass-through is always a bit of an enigmatic question, which I think may deserve a seminar on its own, or at least a bit of a discussion on its own. I don't have one explanation for it. I wouldn't say that there is no pass-through in Malta. I would say that the pass-through is slowed because Malta is peculiar. Now, I don't like to say too much about our peculiarities because sometimes, you say, but what's peculiar about a small island, the small population, a small rock? I think the peculiarity, seriously, explains the slow pass-through, and it also explains the phenomenon that the banks, again, I keep referring to the core domestic banks, fund the bulk of their activity, I would say fund all of their activity, through their retail deposit base, which is core, which is stable. There is no interbank funding in Malta. So this stability and reliability in funding, which is not a recent phenomenon, it is a phenomenon that has been with us always, has to do with the generally high savings propensity of the retail public. So that funding stability also makes the bank tend to price in relation to their base rate. And you find this, that the base rate rarely ever changes. What that means is that when interest rates were decreasing, the pass-through wasn't happening in Malta. But similarly, now that interest rates have shot up so dramatically, again, you don't see that pass-through. So mortgage rates in Malta have remained extremely low compared to Europe. So it is this, I would say, stability that comes from a very reliable and a very resilient, I would say, funding model, which practically all the banks enjoy and have developed over the years, of course, to greater or lesser extent, depending on their own, legacy and model. But this is an explanation which I think needs to be made about the pass-through, and which is, I would say, peculiar to Malta. I don't know if that answers your question.
Yeah, definitely.
Or at least.
Obviously, here we have, especially the core domestic banks, we don't have such a wide number of core domestic banks with a lot of different funding models. Yeah. I mean, in other larger countries, some of them are not, they don't have a very big retail branch network, and therefore basically they have to go to the markets to fund themselves, and therefore the pass-through is immediate when interest rates start increasing, and here we don't have that. I don't know if there are any questions from the audience.
Unfortunately, given that the panel is mostly central bankers, I can only ask you.
Okay, no worries. Thank you.
Okay. On the last topic which we are talking about, I have 2 points. One, I agree with you that the banks have a very solid customer base in Malta, but my question is, could it be that it is because banking in Europe is still very much local both in terms of deposit taking, because especially in recent years over Europe with the rise in AML and CFT conditions, it's very difficult for citizens to open a bank account elsewhere. So actually they don't have much where to go, but the banks have a captive market. And also, of course, on the lending side, they have a captive market too. Because, of course, if you, I mean, especially the local banks are mostly focused on lending for mortgages or real estate. And, of course, if you want to borrow to buy a property in Malta, you cannot go and borrow from another country. So effectively, I would say there is limited competition. And to an extent, this does not apply only to Malta, but I think in certain respects it applies also to other countries in the euro area. But perhaps in Malta, the issue is that we have a relatively small number of banks, so there is more concentration, and you don't have where to go. So effectively, you are locked with a local bank deposit, unless, of course, there are other instruments. And as you rightly mentioned, now that government bond yields have responded to monetary policy, there is, of course, more demand now for them. So I would like to ask you to elaborate a bit on your thinking on that. And the second point is, of course, as you know, monetary policy. The objective of monetary policy is very simple. I mean, interest rate tightening or monetary policy tightening to higher interest rates. The objective is very simple: increase the cost of borrowing for banks and increase the cost of borrowing for their customers as well. And that would help to reduce demand for credit, and therefore that reduced credit demand should have reduced demand in the economy and lower impact on prices. Now, when I look at the local banks, and this was one of my concerns about the interest rate tightening cycle, is that on paper we have variable interest rates in Malta. So my thinking was that this should respond, with interest rate tightening. Cost of credit should go up very, very quickly, but this did not happen. And actually, I mean, we've seen, for example, mortgage rates, as you confirmed, remain stable about 3%. But I remember mortgage rates before the great financial crisis were about 5% at that time. So, are you concerned that you might be blamed? I mean the banks. That actually, because of this lack of pass-through, inflation could remain higher in Malta, especially in the property market, given the concentration of bank credit on the real estate sector?
Look, I think first of all, although the effect or the impact might be seen as marginal or insignificant, the 6 core domestic banks that let's say vary in terms of size, but there has been competition also coming from some of the other banks. You see this. I won't go into detail here, but you see adverts, you see promotion sometimes, and the competition is on both sides of the balance sheet. So we see competition on the funding side, and we see competition on the borrowing side as well. Sometimes their funding models are not the same, and even their pricing models are not the same. Which also leads me to one of your other points, that there was very little pass-through on the variable pricing, on the variable borrowing. I think you will find that, let's say, the 6 core domestic banks, or at least the major players out of them, we still price linked to our base rate. The variable rate pricing is still low. The take-up is still low. It is offered to our clients. Interestingly, what we saw over these last 12 months is that there were clients who had gone to other banks for the variable rate pricing, who now came back and asking for the bank-based rate pricing, because they make their sums, they make their calculations. I don't know. I can only speak for my bank, and maybe with limited visibility on the other banks. But I'm not seeing interest rates. Even let me talk. Okay, we've covered mortgages, we've covered home loans. There's also competition amongst the banks for home loans for a number of reasons. I think a number of banks have seen it as a good diversification strategy. The default rate is very low. In Malta, it is extremely low. much less than 1%. We saw this especially during the pandemic. It was the sector that came out strongest. Also when it came to the moratoria, the lifting of the moratoria. I can speak for my bank, not €1 of default on retail moratoria. Retail is mainly home loans. So banks are going into that segment as well because they see it as a good area of diversification. And if they're going into that segment, they're going to be competing for the pricing. They're not going to raise their pricing. On the corporate and commercial side, I can say that I haven't seen any upward pressures on pricing. The risk spreads have not increased. Again, from my point of view, from my visibility, I'm not saying that there are segments that we're not watching much more closely because of vulnerabilities. Accommodation is one of them, for example. But it doesn't mean that you have increased risk spread. So their cost of borrowing has not increased. I mean, this would be my reaction to your question, Salvador.
Do we have time for the concluding remarks of the panelists?
Yes, sure, yes.
Okay. So
I don't know if there are other questions maybe from the floor. Someone else would like to do an intervention or comment? No? Okay. So
perhaps I can ask
Yes.
each panelist to come up with maybe their concluding remarks very briefly. I will start with you.
So I think comparing where we are now with where we were, say, 20 years ago, the banking sector is much in stronger shape, and both on the monetary and macroprudential side, we have many more tools and better tools to respond in case something goes wrong. But said that, I think the primary line of defense has to come from the regulatory and supervisory side and from within the banks themselves to always exercise prudence. Thank you.
Perhaps just a quick look on the development of macroprudential policies. Also, I think I'm quite confident that it's going in the right direction. I still remember when, before the pandemic in 2019, I think we had 7 countries which had a positive CCYB, countercyclical capital buffer, on the macroprudential side, and 5 countries with a systemic risk buffer. Overall, it amounted to 0.2 percentage points of the whole capital stack, so nearly nothing, very little. Then we had the pandemic. Most of these measures were released. Then came the uncertainty in addition. The war starting in Ukraine, we had the energy crisis, the supply bottlenecks. So a lot of uncertainty indeed. Nevertheless, the notion that uncertainty is not a reason for inaction on the macroprudential sides has been taking track. And now we have nearly double the countries with positive countercyclical capital buffers, nearly double the countries with systemic risk buffers or sectoral systemic risk buffers in place. And the amount of capital secured for this macroprudential has been tripling to 0.6 percentage point of the capital stack. So I think it's going in the right direction. This type of policy, which was new at the time, is seemingly getting more and more traction. And I think that's a very good development, which should help our banking sectors.
I think we are still heading for interesting times when it comes to macroprudential policy. In fact, there is currently the European Commission's review of the macroprudential strategy, where we are taking stock of what went wrong this past decade, room for improvement, and what worked actually, because macroprudential policy seems to have worked fine. Especially we have experienced this during the pandemic. Further work needs to be, more attention needs to be focused on policy evaluation and policy calibration, because calibration frameworks are currently limited, not just domestically, but also on the European front. And I'm aware that there are a number of task forces which are tasked with this task. There are a number of other emerging risks which we didn't have the time to touch upon. Climate, for example. But again, this is work which we are currently looking into, and in fact, even in our FSR, both in the previous edition and this year's edition, we have analyses with regards to climate, cyber risk. I mean, perhaps it's more micro-oriented than macro, but again, this is room for further analysis. And in fact, also the ECB next year will be running a cyber resilience stress test. So we see the importance of this. The NBFI sector, the non-bank financial sector, is something that we haven't touched upon, but again, this is area for further work. So yes, I mean, these are interesting times. Going forward, I think we need to stress upon the importance of having releasable buffers in place, that we address any impediments for buffer releases, because these have come to light in recent past. So yeah, I'll leave some time for...
Oh, actually, just linking back to one of my last points, but also touching on what the speakers are concluding. Just a word about the buffers, because I didn't mention the buffers at all today. I think the introduction of the sectorial systemic risk buffer now coming into action as at the end of this quarter, and then being fully loaded by the end of the first quarter next year, I think it's timely. It's the right measure, it's the right buffer to be introduced, also with regard to, let's say, some softening risk in the real estate market. So that's what I was mentioning earlier, also about the accommodation sector, and also it was good to hear that an introduction of maybe the counter-cyclical buffer for Malta is still way off, because I don't think it would be the right tool to introduce or to implement at this stage. That's all from me.
That's good to hear.
From
the practitioner's side.
No, definitely. We've always been a bit kind of, I would say, hope the counter-cyclical buffer is still some way off.
Thank you very much for all the panelists.
So thank you very much to our panelists today as well for their valid interventions. And to end today's launch, I now invite Mr. Oliver Bonello, the bank's Deputy Governor on Financial Stability, for his closing remarks.
Governor, distinguished guests, ladies and gentlemen, it is indeed my pleasure to make a few closing remarks and express my sincere thanks for your participation in this event. I would also like to thank all the staff who contributed towards the publication of the Financial Stability Report, and all those involved in making this seminar a resounding success. This morning, we have delved into some important elements of financial stability with the aim of managing risks for the well-being of our economy, businesses, and the livelihood of citizens. We have seen that in the face of a confluence of risks, the Maltese financial system remained resilient. Banks' liquidity increased further, and profits continued to recover, while capital levels remained healthy. The bank's asset quality improved, but going forward, this could be threatened, as borrowers' repayment capabilities could be challenged in the face of tighter conditions, monetary conditions, high inflation, and potentially more subdued economic growth. Household indebtedness is rising, while cyclical risks continue to build up, driven by the still expansionary mortgage activity and real estate developments. As a bank, we are committed to continue monitoring the evolving macro-financial landscape and proactively take the necessary measures to continue to ensure a solid and sustainable foundation for our financial system. We have also seen how the banking sector can rely on its strengths to face potential threats and vulnerabilities on the horizon, and how it can transform any weaknesses into opportunities. A case in point is the need to diversify lending activities, while at the same time aid in the climate transition of the Maltese Islands. We heard the Honourable Minister on the importance of the green transition and the fast pace that it needs to take place. I cannot but also stress the importance of banks to keep track of emerging risks that cyber brings about, cyber threats. We have seen that the construction of a cyclical systemic risk indicator involves the careful consideration of various macroeconomic and financial indicators, such as credit and debt levels, among others. This new indicator is an addition to our toolbox for signaling when financial imbalances are building up and help us in making well-informed decisions and implement targeted macroprudential policies to address potential threats in a timely manner. The Honourable Minister also referred to the rapid changing environment and to adapt to faster decision-making. The panel discussion offered unique perspectives on the complex interplay between macroprudential and monetary policy, highlighting the delicate balance between ensuring price stability while at the same time containing systemic risks that could threaten the stability of our financial system. During the discussion, some interesting points were raised, which I would like to highlight as our take-home messages. Macroprudential policy, together with supervision, prevents the excessive buildup of risks and make the financial sector more resilient, while limiting contagion effects. Of course, we need to take cognizance of the digital challenges the financial sector is operating in and the safeguards that we require. At the same time, there could be trade-offs between implementation of macroprudential measures to address systemic risk while supporting the intermediation capacity of banks and hence contributing towards further economic growth. We heard during the discussion about the unintended consequences in a rising interest rate environment and the challenges that the slow pass-through could pose to the banks. Another key takeaway is the need to strike a balance between the standardization of macroprudential policy and national characteristics. Moreover, the panel emphasized the need for constant evaluation and refinement of these policies as market dynamics change. We must adapt our strategies and frameworks to meet new challenges and prevent the potential buildup of risks that may pose threats to our overall financial system. At this juncture, it seems that the current consensus is that the macro-financial environment calls for a cautious approach and continuous monitoring is warranted, so not to release buffers. At this stage, we need to focus on the resilience aspect and not the cyclical aspect. This, however, does not necessarily mean that macroprudential authorities should not act when required. Finally, I would like to spare some thoughts on the recommendations spelled out in this edition of the Financial Stability Report. Like in previous editions, the Central Bank encourages banks to continue adopting prudent credit risk management practices and proactively identify possible credit losses and set aside adequate provisions. Also, from the discussion, I positively note that the industry seems to be in line with our recommendations with respect to implementation of buffers, particularly the new one. Indeed, with effective capital planning, banks would be better placed in dealing with any losses incurred on account of softening economic conditions, increase regulatory requirements, and are also more resilient to unpredictable events. With this, I would like to bring this event to a close. I would also like to extend my gratitude to all our speakers and panelists, especially Dr. Detkin from the ECB, who has joined us specifically for this event, and last but not least, to our events team for making this seminar possible. I hope that you have found today's presentations and discussions insightful, and we look forward to having you with us at similar events in the future. Thank you, and I wish you all a nice afternoon.
Thank you very much, Mr. Bonello, for your remarks. Dear guests, this has brought our event to an end. I thank once again on my own distinguished speakers for their varied interventions, and yourself for having attended this financial stability report. We do hope that you found it interesting. May I remind you that this recording of this event will be posted on the bank's social media channels later on. I also wish you a lovely afternoon. Thank you.